Let me tell you something I learned the hard way. The market does not care about your dreams, your plans, or the size of your account. It only cares about the truth written in price and volume. Now, you might have heard the question floating around trading circles, can a man really turn $100 into 10,000? It's an attractive thought, isn't it? A small stake, a big reward. Who wouldn't be tempted by that idea? But the market is a stern teacher, and it has a habit of separating possibility from probability. Yes, it is possible. The market has made large fortunes from small beginnings. I've seen men start with very little and build great positions over time. But the key words there are, over time. The tape does not hand out riches simply because a man wishes for them. Now think about this for a moment. If turning $100 into 10,000 were easy, wouldn't everyone be doing it? You see, the public often approaches the market with the wrong idea. They believe the goal is to find the one magical trade, the one move that multiplies their account overnight. They hunt for the perfect entry, the secret indicator, the hidden pattern. But trading is not a treasure hunt. It is a game of judgment. A man must learn to read the market the way a sailor reads the sea. The charts, the price movement, the rhythm of supply and demand. Those are the real teachers. When a stock begins to move with strength, when the volume confirms the move, when the market itself supports the trend, that is when the wise trader pays attention. But let me ask you something. If you only have $100, what does that really mean in trading terms? It means you have very little room for error. The market is uncertain. Even the best traders are wrong many times. Losses are part of the profession. A small account magnifies every mistake. One bad trade can damage it badly. 2 or 3 careless trades can wipe it out entirely. And that's the part most people don't like to hear. They come to the market hoping for freedom, but they bring impatience with them. They want the 10,000 now. They want the big win this week. They want excitement instead of discipline. But speculation is not about excitement. It is about patience. When I was learning the game, I discovered something important. The big money is not made in the buying or the selling. It is made in the waiting. Waiting for the right conditions. Waiting for the market to reveal its intentions. Have you ever noticed how the best chart patterns take time to form? A base develops slowly. Price tightens. Volume dries up. Then suddenly, the stock begins to move. The breakout comes with force because supply has been absorbed. That's not luck. That's the law of supply and demand working itself out on the tape. Now imagine trying to turn $100 into 10,000 without understanding that law. What would you really be doing? You'd be gambling. And the market punishes gamblers sooner or later. A trader who wants to grow a small account must think differently. He cannot chase every move. He cannot jump in and out of the market all day. Commissions, spreads, and mistakes will eat him alive. Instead, he must learn to wait for the clearest opportunities. He must learn to protect his capital. Because capital, no matter how small, is a trader's lifeblood. Without it, he cannot participate in the next opportunity. And the next opportunity is always the one that matters. Now let me ask you another question. When you look at a chart, what do you actually see? Do you see noise, or do you see behavior? Every price movement represents the actions of thousands of traders. Fear, hope, greed, doubt, all of it leaves fingerprints on the chart. A sudden spike in volume might mean institutions are stepping in. A quiet pullback during an uptrend might show that sellers are running out of strength. This is the language of the market, and once a trader begins to understand that language, something changes. He stops chasing predictions and starts observing facts. He doesn't argue with the market anymore. He listens to it. That mindset alone separates many winners from the crowd. Because the crowd wants certainty. They want someone to tell them exactly what will happen next. But no man can know the future of the market. What we can do is recognize favorable situations. A strong trend. A clear breakout. A healthy consolidation. Those are the conditions that give a trader an edge. Now imagine a disciplined trader starting with a small amount of money. Instead of chasing 10 trades a week, he waits for the best setups. He risks only a small portion of his account each time. He lets his winning trades run while cutting losses quickly. What happens over time? The account begins to grow slowly. Not dramatically, not overnight, but steadily. And that is the reality most people overlook. Turning $100 into $10,000 is not a single event. It is a process. A long chain of disciplined decisions. Each trade adding a little progress, each mistake teaching a lesson. But the public does not like slow progress. They want fireworks. So they take oversized risks. They buy at the top of emotional moves. They ignore the chart and listen to rumors instead. And when the trade turns against them, they hold on, hoping the market will forgive them. But the market rarely forgives hope. Hope is not a strategy. A trader must act on evidence. Price movement, volume behavior, trend structure. These are the facts of the market. Everything else is opinion. Now think about the psychology involved. A man with $100 account might feel pressure to double it quickly. He might feel that small gains are meaningless. After all, what is $5? What is $10? But that thinking is dangerous, because trading skill is built through repetition, through consistency, through learning how to manage risk and read the market. If a trader cannot grow a small account carefully, what makes him believe he can manage a large one? Money only magnifies behavior. A careless trader with $100 becomes a disastrous trader with $10,000. But a disciplined trader, he carries the same habits upward as his account grows. That is how real traders build wealth. They do not focus on the final number. They focus on the process, on reading the market correctly, on protecting capital, on letting probability work in their favor over time. And when you understand that, the question changes. It is no longer, can I turn $100 into $10,000? The real question becomes, how do you become the kind of trader who deserves to manage $10,000 in the first place? Because the market has a way of testing every weakness in a man's character. Impatience, greed, fear, they all appear when money is on the line. And if a trader cannot control those emotions, what do you suppose happens when the chart begins to move against him? Let me tell you about a mistake I've watched traders make again and again. It is the belief in the one big trade. The idea that somewhere out there in the market is a single opportunity so powerful that it will multiply their money overnight. A trade that turns a small account into a fortune in one bold move. Now ask yourself honestly, have you ever thought that way? A man opens his trading account with a small amount of capital. Perhaps $100, perhaps a few hundred. Immediately his mind begins calculating. If I can just catch one big move, if I can just find the right stock, this account could explode. And right there, before he even places a trade, the trouble has already begun. Because trading is not about catching miracles. It is about managing probabilities. The public loves the story of the one lucky trade. The trader who bought at the perfect moment and rode the market straight up. These stories spread quickly. They sound exciting. They make the market feel like a lottery ticket waiting to be scratched. But the truth is far less glamorous. The men who last in this business do not depend on a single trade. They depend on a method. You see, the market moves in waves. Trends form, pause, and continue. Sometimes the move is strong, sometimes it fails. A trader's job is not to guess the biggest move in advance. His job is to recognize favorable conditions and participate with discipline. But the beginner rarely thinks that way. Instead, he searches for that one opportunity that will change everything. He scans charts not for probability, but for promise. He wants confirmation that the next trade will be the one. Let me ask you something. If your entire trading plan depends on one big trade, what happens if that trade is wrong? Because the market does not guarantee anything. A stock can break out and then reverse. A trend can look perfect and suddenly collapse. News can appear without warning. Liquidity can disappear when you need it most. These are not rare events. They are ordinary parts of market behavior. Yet the beginner ignores this reality. He places an oversized position, convinced that the move will be large enough to justify the risk. The potential reward blinds him to the possibility of loss. And loss, as every experienced trader knows, is always present. The professional speculator approaches the market differently. He understands that no single trade matters very much. What matters is the long series of trades that make up his career. One trade might produce a small gain. Another might result in a loss. A third might run much farther than expected. Over time, the mathematics of discipline begin to work in his favor. That is how accounts grow. Not from a single dramatic victory, but from a chain of sensible decisions. Now consider what the charts are really showing you. When price breaks out from a consolidation, it may signal the beginning of a strong trend. Volume may expand as institutions accumulate shares. Momentum may carry the stock higher for weeks or months. These moves are valuable opportunities. But even the best-looking breakout can fail. So the skilled trader enters with a clear plan. He limits his risk. He watches the behavior of the stock after entry. If the price confirms his judgment, he allows the trade to develop. If the market proves him wrong, he exits without hesitation. That is discipline. The man searching for the one big trade rarely practices it. He cannot afford to. His entire hope rests on that single opportunity. When the trade moves against him, he hesitates. He tells himself the market will come back. He adds to the position. He refuses to admit the mistake. And slowly, the market begins to teach him a painful lesson. The problem is not simply financial. It is psychological. Believing in the one big trade creates emotional pressure. Every decision begins to feel enormous. Every price movement feels personal. A small loss becomes unbearable because it delays the dream of a massive gain. But trading under pressure leads to poor judgment. A trader starts forcing trades that are not really there. He sees patterns that do not exist. He enters positions too early or too late. He abandons patience because he feels time slipping away. Tell me, how often do the best chart patterns appear? Not every day. Sometimes the market drifts sideways for long periods. Volume dries up. Price action becomes noisy and uncertain. During those times, the disciplined trader waits. He observes. He protects his capital. But the trader searching for the one big trade cannot wait. Waiting feels like failure. So he jumps into mediocre setups, hoping one of them will suddenly explode. Most of the time, they don't. The irony is that large moves in the market do happen. They happen more often than people realize. Entire sectors can trend strongly. Individual stocks can double or triple over time. But those moves reward patience, not desperation. They reward the trader who enters carefully and allows the trend to unfold. The trader who adds to his position when the market confirms his judgment. The trader who rides the wave instead of trying to predict the exact moment it begins. That approach may not sound dramatic. It may not produce exciting stories at dinner parties. But it is the approach that survives. And survival is the first rule of speculation, because once a trader survives long enough, once he learns to read the market's behavior, once he develops patience and control, then the market begins to reveal opportunities he never noticed before. Strong bases forming quietly, volume expanding beneath the surface. Trends building momentum while the public remains distracted. And the trader who once searched desperately for the one big trade begins to understand something far more important, that the real power in trading does not come from a single moment of brilliance, but from a single moment of correct decisions, while the market quietly unfolds its intentions. Most people walk into the market, believing the new value. They read headlines, listen to rumors, and wait for someone to tell them which stock is about to move. But the seasoned trader learns a different lesson. The market speaks its own language, and that language is written in price and volume. Now think about it for a moment. If you truly want to understand what the market is doing, where should you look? At opinions or at the chart? Because the chart does not argue. It simply records what buyers and sellers have already done. Every tick in price is a decision made by someone risking real money. And when thousands of those decisions gather together, they form patterns. Those patterns are not random scribbles. They are the footprints of supply and demand. Let me explain something simple. When demand becomes stronger than supply, price rises. When supply overwhelms demand, price falls. This law is older than the stock market itself, and it governs every chart you will ever see. But here is where price alone tells only part of the story. Volume is the market's level of conviction. If a stock rises on light volume, It means only a small group of buyers is pushing the price higher. The move may continue, but it lacks strong confirmation. On the other hand, when price rises sharply with heavy volume, something more important is happening. Large interests are stepping in. Institutions, funds, professional operators. These players move far more money than the average trader. When they accumulate a stock, they cannot hide it completely. Their buying pressure reveals itself through rising price accompanied by expanding volume. Have you ever noticed how the strongest trends often begin quietly? A stock might move slowly at first. The price inches upward while volume begins to increase. To the casual observer, nothing dramatic is happening. But to a trader watching the chart carefully, the message is becoming clear. Demand is building. Now let me ask you something. Why do experienced traders watch these signals so closely? Because they are clues to intention. The market is not moved by opinions or predictions. It is moved by capital. When powerful participants begin committing their money to a stock, their actions appear on the chart long before the news becomes obvious to the public. That is why price and volume matter so much. They reveal behavior. For example, imagine a stock forming a base. The price moves sideways for weeks. Every time it dips, buyers step in. Volume shrinks during the pullbacks and expands slightly during the rallies. What does that suggest? It suggests that sellers are gradually being absorbed. Supply is drying up, and when supply becomes scarce, even a modest increase in demand can push price upward quickly. That is often how breakouts begin. But not every breakout succeeds. Sometimes a stock jumps above resistance on weak volume. The move looks exciting, but there is no real participation behind it. Without strong demand, the price soon slips back into the range. That is the market revealing the truth. Price gave the signal, but volume exposed the weakness. A trader who understands this relationship begins to see the market differently. Instead of guessing where the price should go, he observes how buyers and sellers are behaving right now. Is volume expanding as the trend continues? Are pullbacks shallow and controlled? Is the stock holding above important levels? These are the questions that guide a disciplined trader, because the chart is not predicting the future. It is showing the present, and the present often contains the earliest clues about what may come next. The mistake many beginners make is ignoring this evidence. They buy simply because a stock feels exciting. They sell because fear suddenly appears. Their decisions come from emotion instead of observation. But the chart remains patient. It continues recording every transaction, every burst of buying, every wave of selling. Over time, the trader who studies price and volume begins to recognize recurring behaviors. Accumulation, distribution, breakouts, exhaustion. These patterns repeat because human behavior repeats. Fear and greed have not changed in 100 years, and they are visible on the chart just as clearly today as they were decades ago. So when you look at a chart, you are not just looking at lines and candles. You are looking at the battle between supply and demand unfolding in real time. One of the most overlooked forces in trading is position sizing. Most beginners think success comes from picking the right stock or catching the perfect breakout. They spend hours searching for patterns, indicators, and predictions. But they rarely stop to ask a far more important question. How much should I risk on a single trade? That question alone decides whether a small account survives long enough to grow, yet many traders treat it as an afterthought. Now consider a trader starting with a small account, perhaps $100. The temptation is obvious. If the account is small, the trader feels he must take large risks to make meaningful progress. A $5 gain feels insignificant. A $10 gain feels slow. So he does something dangerous. He commits a large portion of his account to a single trade. Let me ask you something. If half your capital is placed into one position, what happens when that trade goes wrong? Because trades do go wrong. Even the strongest chart patterns fail sometimes. Breakouts can reverse. Trends can stall. The market has a habit of surprising everyone. If the position is too large, a single mistake can cause serious damage. 2 mistakes can cripple the account. 3 or 4 can remove it from the market entirely. And once the capital is gone, the opportunity to learn disappears with it. This is why experienced traders treat position sizing as a form of protection. They understand that survival comes before profit. Think of it this way. A trader who risks only a small percentage of his account on each trade gives himself room to be wrong. He can take several losses without destroying his capital. Each loss becomes a lesson rather than a disaster. But a trader who risks too much places himself under constant pressure. Every price movement begins to feel threatening. A small pullback creates anxiety. A normal fluctuation feels like danger. Under that kind of stress, clear thinking becomes difficult. The chart may be showing perfectly normal behavior, but the trader cannot tolerate it. So he exits too early. Or worse, he refuses to exit at all. Position sizing also affects how a trader handles opportunity. When risk is controlled, a trader can focus on reading the market objectively. He can observe price action, watch volume behavior, and allow the trade to develop naturally. But when the position is oversized, the trader becomes emotional. His attention shifts from the chart to his profit and loss. Every tick of the market feels personal, and trading decisions made from emotion rarely end well. Now look at the matter from a longer perspective. Trading is not a single event. It is a long series of trades unfolding over months and years. Some trades will be profitable, others will not. The goal is not perfection. The goal is consistency. Position sizing is what makes consistency possible. By limiting risk on each trade, the trader protects his ability to participate in the next opportunity, and the next one, and the one after that. Let me ask you something worth thinking about. If a trader cannot manage risk with $100, what will happen when he trades with 10,000? The habits remain the same. A reckless trader with a small account simply becomes a reckless trader with a larger account. The numbers change, but the behavior does not. Losses become larger. Stress becomes heavier. The cycle repeats itself. But a disciplined trader grows differently. He begins by respecting his capital, no matter how small it may be. He understands that every dollar represents opportunity. Instead of chasing dramatic gains, he focuses on protecting what he already has. This approach may appear slow from the outside, but trading is not a race. It is a process of learning how the market behaves and how one's own emotions respond to risk. Position sizing sits at the center of that process because it shapes every decision a trader makes. It determines whether patience is possible. It determines whether losses remain manageable. It determines whether the trader remains calm enough to read the chart clearly when price begins to move. Impatience is one of the most dangerous forces in trading, and it becomes even stronger when a trader is working with limited capital. A small account often creates a sense of urgency. The trader looks at the balance and begins to feel that time is working against him. Every day that passes without a large gain feels like a missed opportunity. Now let me ask you something honestly. When you look at a small trading account, what thoughts appear first? Do you think about learning the market? Or do you immediately start calculating how fast it can grow? Most beginners fall into that second habit. They stare at the number and imagine how quickly it could multiply if the right trade appears. The mind begins to chase outcomes instead of focusing on the process. And that is where impatience quietly begins to take control. Because the market rarely moves according to a trader's schedule. There are long periods when price drifts sideways, when trends pause, when opportunities are unclear. A disciplined trader understands that these quiet periods are part of the market's rhythm. But the impatient trader struggles during these moments. He feels the need to do something. Instead of waiting for a clear setup on the chart, he begins forcing trades. A small move looks like the beginning of a breakout. A weak pattern suddenly seems convincing. He convinces himself that action is better than waiting. Tell me, how often do the best chart patterns appear? Not very often. The strongest opportunities usually develop slowly. A base forms over time. Volume contracts as sellers disappear. Price begins tightening within a narrow range. These conditions build pressure, and when the breakout finally occurs, it has the energy to move. But that kind of setup requires patience. The impatient trader rarely waits long enough to see it. Instead, he jumps into the market repeatedly, hoping that one of those trades will suddenly explode. Each trade carries a small hope of a big move, but most of them lack proper conditions. Over time, the account begins to suffer, not because the trader is incapable of reading a chart, but because he cannot resist the urge to act. Commissions, spreads, and small losses slowly drain the account. The trader becomes frustrated, which only increases his impatience, and the cycle continues. Now consider the psychology behind this behavior. A small account can make profits feel insignificant. A $2 gain seems meaningless. A $5 gain feels like slow progress. The trader begins to believe that small wins are not worth the effort. But that thinking is dangerous, because trading skill is built through consistent execution. Small gains, small losses, careful entries, disciplined exits. These are the repetitions that shape a trader's judgment. They teach him how the market behaves and how his own emotions respond to risk. Impatience interrupts that learning process. When a trader constantly chases rapid growth, he stops observing the market carefully. He stops analyzing price and volume behavior. Instead, he focuses only on speed. How fast can this trade move? How quickly can I double this account? But the market does not reward urgency. It rewards discipline. Let me ask you another question worth thinking about. Have you ever noticed how many strong trends begin quietly? When most traders are distracted, a stock may start climbing slowly while the public ignores it. The chart shows steady demand. Volume gradually increases. Pullbacks remain shallow. These are the early signs of accumulation, but the impatient trader often misses them. Why? Because the move feels too slow at first. He wants immediate excitement, not gradual strength. By the time the trend becomes obvious, he enters late, often near the top of the move. And when the inevitable pullback comes, fear replaces impatience. This emotional shift, jumping between urgency and fear, is common among traders with small accounts. The limited capital magnifies every outcome. Gains feel too small. Losses feel too large, and patience becomes difficult to maintain. Yet patience is exactly what the market demands. The trader who learns to wait gains a powerful advantage. He allows the chart to reveal its structure. He studies how price behaves near support and resistance. He observes whether volume confirms the move. Instead of forcing trades, he waits for the market to invite him in. That simple change transforms the entire experience of trading. Decisions become calmer. Risk becomes manageable. The trader begins to see the market with clearer eyes. Because once impatience is removed from the equation, the chart begins to speak more clearly. One of the quiet mistakes many traders make is constantly changing their strategy. They begin with one method, try it for a short period, and when results are not immediately impressive, they abandon it and search for something new. A different indicator, a different pattern, a different system promising better results. At first this feels productive. The trader believes he is improving his approach, but in reality, he is doing something far more damaging. He is interrupting the learning process. Let me ask you something worth thinking about. How can a trader truly understand a strategy if he never uses it long enough to see how it behaves across many trades? Because no trading strategy wins all the time. Even the best setups will produce losses. Markets move through different conditions. Sometimes they trend strongly. Sometimes they move sideways. Sometimes volatility increases without warning. A strategy must be observed across many situations before its strengths and weaknesses become clear. But the impatient trader rarely waits for that understanding. Instead, he expects immediate success. When the first few trades fail or produce small gains, doubt appears. Suddenly the strategy feels flawed. He begins looking for something better. So he changes the rules. Perhaps he adds a new indicator. Maybe he switches from breakout trading to scalping. A few days later he studies mean reversion. Then he hears about another technique and begins experimenting again. Now think carefully about what is happening during this process. The trader is not building skill. He is collecting fragments of different ideas without mastering any of them. Trading requires repetition. A trader must see the same type of setup again and again. He must watch how it forms, how it behaves after entry, and how often it fails. Over time, this repetition develops intuition. Charts begin to feel familiar. A trader recognizes subtle details, the way volume expands before a breakout, the way price behaves during a healthy pullback, the difference between strong momentum and weak enthusiasm. These observations come only from consistent practice, but when strategies change constantly, that familiarity never develops. Every trade becomes a new experiment, and experiments are unpredictable. Let me ask you another question. If a trader changes his method after every losing trade, what is he really learning? Very little, because losses are not always evidence that the strategy is wrong. Sometimes they are simply part of normal probability. A method that wins 60% of the time will still produce losing streaks. Without consistency, the trader cannot see the larger pattern. He begins blaming the strategy for problems that actually come from impatience or poor execution.